Most investors think gold only rises during times of crisis, but in 2026, gold's story is much bigger than inflation fears or geopolitical headlines. It has become one of the world's most important macro assets, and understanding what's driving its rise helps explain broader shifts in the global economy. One of the biggest drivers is the US dollar. Historically, gold and the dollar have shared a strong inverse relationship. Because gold is priced globally in dollars, a weaker dollar makes it more affordable for international buyers, often boosting demand. If the dollar continues to face pressure from large fiscal deficits, changing interest rate expectations, or shifting global capital flows, those conditions could remain supportive for gold. Demand for gold also comes from three major sources. Jewelry accounts for roughly 35% to 50% of global demand. Investment demand, including bars, coins, and ETFs, typically contributes 20% to 30%, and central banks now represent another 20% to 30%. Central bank buying has become one of the strongest structural drivers of the gold market. As countries continue diversifying reserves and reducing long-term dependence on traditional reserve currencies, several broader economic trends also support gold. Global debt remains elevated, governments continue running large deficits, and investors remain concerned about long-term currency debasement. At the same time, traditional diversification has become less reliable. Since the inflation shock of 2022, stocks and bonds have often declined together, leading many investors to seek alternative stores of value, with gold benefiting from that shift. China also plays a critical role. As one of the world's largest gold consumers, its demand heavily influences global prices. Even after substantial price increases, Chinese buying has remained resilient, suggesting many consumers continue viewing gold as both a store of wealth and financial security rather than simply jewelry. While these forces help explain gold's strength through 2026, no bull market moves in a straight line. Gold has historically experienced periodic corrections of 10% to 15% even during major uptrends, and increased investor enthusiasm can lead to higher volatility. There are three major risks that could threaten the current bull market. First, a sustained rebound in the US dollar could reduce demand for gold by making dollar-denominated assets more attractive. Second, weaker Asian demand, particularly from China, or increased scrap supply could ease pressure on prices. Third, a slowdown in central bank purchases would remove one of gold's strongest long-term sources of demand, since official institutions now account for roughly 1/5 to 1/3 of global buying. As of 2026, however, these risks have not overtaken the broader trend. High debt levels, ongoing geopolitical uncertainty, continued central bank reserve diversification, and strong investor demand for alternatives to stocks and bonds continue to support the market. None of this guarantees higher prices, but it explains why gold remains central to so many investment portfolios. Gold is no longer viewed simply as a crisis asset. For many investors, it has become a strategic allocation for diversification, inflation protection, and long-term wealth preservation. And while volatility is inevitable, the forces supporting gold today extend well beyond any single headline. In 2026, gold isn't just reacting to uncertainty, it's reflecting how investors around the world are preparing for a changing financial system.